Good morning, everyone. This is Kevin Zhao, your finance professor at MTSU. Welcome back to the class. This is the third week of the class. I want you guys to know that after a very intense second week, the third week will remain intense regarding the amount of material that we are going to cover and the other work that we needed to do. So, I already reviewed your first exam. I think on average the class did a pretty good job on the first exam. You may check your grade on D2L, and also you may look at the review video of the first exam where I show you the process of solving those typical problems in the first exam. Okay, during the third week, we are going to cover 4 chapters, all associated with stock valuation models. Today we are going to go through chapter 13, this dividend discounting model. In the next 2 chapters, we'll go through free cash flow to fund model, and also you have two online classes to cover by yourself. One is free cash flow to the equity chapter, as well as the chapter for estimating terminal value when you use two-stage models. Now let's start our discussion on chapter 13. This is a pretty easy chapter, dividend discounting model, and this is the first stock valuation model that you learn in any finance book, where stock price equals the next time period dividend divided by the difference between required rate of return and the growth rate. This is a very simple model. However, you cannot use this model for many stocks because this model requires you to have assumption where the growth rate of dividend in a company is a constant number, which is not realistic for most companies tradable on the market. But anyway, let's look at this constant growth model. This model is also called a golden growth model. And in this model, we have 3 inputs. The first one is next time period dividend, and the second one is the required rate of return, and the third one is growth rate. Previously, we fixed a lot of issues regarding those valuation parameters, where our primary goal is to get a good estimation on required rate of return or the cost of equity. And also, we learned a little bit on how to determine that growth rate for many different types of companies. And in this very simple golden growth model, we have a very important variable here, which is the growth rate, and we assume this growth rate is constant number indefinitely. And more realistically, you wanted to have a good estimation on this growth rate, and the theory says this growth rate that you used in this constant growth model should equal to long-term expected inflation rate plus the real growth in GDP. So if your estimation of real growth in GDP is 1% and long-term inflation rate is 2%, then it will give you estimation of 3% constant growth rate. That's pretty typical. And here you see, okay, this number can go as high as 8% or as low as 5%, but it all depends on your estimation of long-term inflation rate and the real growth in GDP. If company is a multinational company, then typically we would expect a higher real growth of the world economy. It could be 1% higher. And this model is not for all stocks, and I would say maybe for all the stocks trading on the market, less than 20% of those could use this constant growth model, because most companies do not have a constant growth for their dividends, and many companies don't even pay dividends. So in what scenario that we can use this model? Well, here I can show you that 4 typical companies are suitable for using this constant growth model. And the company should have first of all a stable growth rate, not necessarily a constant growth rate, but you should pick the company that has a pretty stable growth rate, and the company tend to be a mature company and a large company. And the second, you look at the dividend the company pays, and it's better to have a company that has dividend uh, approximately equal to its free cash flow to equity. And the third characteristic of a company is the company should have stable leverage, and typically the company will have a high leverage. And the last one is the company should have low risk. Well, beta is close to 1, so make sure you look at the nature of the company, and if company satisfies those 4 criteria, then it could be a good candidate for using this constant growth model. In reality, we have 3 basic types of company that we can use this constant growth model. The first one is regulated company, especially the utilities companies. And the second type of company is large financial services companies, such as banks, investment banks, and so forth. And the last one is REITs, real estate investment trust. Okay, to understand how to use this model, it's better to demonstrate one example on how to use this constant growth model for a company called Con Edison back to year 2006. And this company is a utility company. For utility company, you wouldn't expect that it has high growth rate because it's a local monopoly. All the market share is captured by local utility companies, and only growth can come from the regional growth or economic growth of the country. And the company is in stable growth based upon size and area that it serves, and its rate also. The rates of electricity are also highly regulated. It's unlikely the regulator will allow profits to grow at extraordinary rates. And the second, this company has low risk, where beta is at 0.75, and it's been stable for a long time. And the third, this company has stable leverage, and lastly, the company pays a dividend that is roughly equal to its free cash flow to equity. So when you look at those firm characteristics, you would say, hey, this utility company is a good candidate for us to use golden growth model. Now let's take a look at its free cash flow as well as dividends. During the time period between 1991 and 1995, the average annual free cash flow to the equity is about $480 million, and its average dividend payments during the same time period is $461 million, and the dividend payout ratio of the free cash flow to equity is nearly 100%. Here's 96%. So this utility company is a good candidate for us to use this golden growth model. Now let's take a look at the basic information of the company. EPS is $2.95. Dividend payout ratio 70%, and dividend per share is about $2. Expected growth is assumed at 5%, and given beta 0.75, we can estimate cost of equity back to 1996, which is about 10.13%. So here you have all 3 critical inputs: dividend payment, required rate of return, as well as the constant growth rate. And notice that the dividend paid in 1995 is D0. What we need is D1. D1 equals D0 times 1 plus the growth rate. So when we apply this constant growth rate, the value of the stock equals D0, $2.04 times 1 plus G. That will give you D1, next time period dividend. Then divided by the difference between cost of equity and the growth rate. Then you will come up with $41.80 of stock price estimation. And in 1996, Con Ed was trading for $30 on the day of the analysis. So you see your valuation is not quite close to the market valuation. What's the problem? I think the first problem that you need to check is your estimation of the growth rate. You assume that 5% would be the constant growth rate, but for utility company, maybe this growth rate should be just lower. So what's the growth rate that is reflecting the current stock price? Okay, we can look at this solution. Let's say, hey, we know current stock price $30. Then we apply this same constant growth model. Given this growth rate is unknown, then we can solve for this growth rate, which is about 3.12%. So the dynamic here is that in 1996, the market believes that the growth rate of this utility company is about 3%, which is consistent with $30 stock price estimation. If your estimation of growth rate is higher, then stock price, of course, will certainly go higher. This growth rate is a very sensitive factor in this model. And you see this table shows you that how sensitive this growth rate is against the stock price estimation. When growth rate is as high as 7%, the stock valuation would be around $70. And if it's a 5%, then stock price would be above $40. But at the market price of $30, the growth rate is about 3%. If growth rate go even lower, stock price will go even lower. So there's a inverse relationship between stock price estimation and the growth rate. So this is a very good example demonstrating how to use constant growth model. And let's go to another example, JP Morgan. JP Morgan's financial services company. Once again, financial services company is another good candidate for us to use golden growth model. Here's a little background information about JP Morgan back to 1996. EPS $6.30, payout ratio 47.62%, dividend per share $3. And expected growth rate is 7% with stock price of 1.15%. We can estimate cost of equity around 12%. Then we can directly apply this constant growth model. D0 $3 times 1 plus G. G is 7% as we assume. Then divided by the difference between cost of equity and growth rate to come up with $60 estimated stock value. And on the same day, on the day of the analysis back to January 1996, JP Morgan was traded for $80, which means that the market may have higher estimation of the growth rate, maybe a number that is higher than 7%, maybe 7.5% or 8%. And you can actually do a little calculation to see what was the market estimation of the growth rate for JP Morgan in January 1996 by using the same constant growth model. And the third example is to look at S&P 500 index in 1996 to see what is the your estimated S&P 500 index. And then here we look at a dividend. The average dividend yield for the stock in the index at the end of 1995 is 2.32%. And the level of the index in January was 600. And here we are going to use this golden growth model. First of all, we look at the cost of equity, and the cost of equity equals risk-free rate plus beta. Beta should equal to 1 for the market index, and equity premium of 5.5%. So here you come up with required rate of return for index for the stock market would be 11.5%. 6% risk-free rate, beta equal to 1, ERP 5.5%. And then we assume the growth rate equal 6% in the longer term. Therefore, the intrinsic value of the market would equal to D0, 14.19 times 1 plus G is 6% divided by 11.5% cost of equity, and the growth rate you come up with 273.57. That is your estimated S&P 500 index on January the 1st, 1996. So every time we come up with stock evaluation, you really want to check this with the market price to see if your estimations is reasonable or not. And here, the stock index was 600, not 273. I mean, if you get something close to 600, that will be reasonable. But if you find there's a huge difference, you want to double check if there's any big problem in your valuation. And here, is there anything wrong with your estimation of growth? I would say, hey, 6% would be reasonably estimated. Cost of equity doesn't look you're getting the wrong number. And when you look at a dividend, well, it's a dividend yield times the index level. It looks like everything's fine, right? But how can you get a number that's way off the market price of 600 in 1996? Where's the problem? Well, the problem is here, the dividend payment. And now we know that a lot of U.S. large corporations do distribute the cash back to shareholders, not through dividend payment, but through stock repurchases. And as you see, the dividend yield is about 2.3%, but actually the corporations return more cash to shareholders through its stock repurchase programs. And in 1995, 1996, when you look at all stock repurchases, it accounts about 3% of the overall index. So here, our estimation of cash flow regarding dividend is underestimated because we ignore the stock repurchases. Now, let's put this stock repurchase back into our evaluation. Let's say the total yield equals dividend yield plus the stock repurchase yield. And then we are getting a much more realistic estimation of the S&P 500 index. Let's assume that the dividend yield in future years is about 3% and plus 3.5% stock repurchase yield. Then the total cash yield for S&P 500 index stocks is about 6.5%. Assuming 6% growth rate, you will come up with 524 index level. And if you adjust your growth rate a little bit higher, you will reach the market level 600. So that is a constant growth model estimation of S&P 500 index. Now, let's take a look at the second model in this dividend discounting model method. The first one is constant growth model, where we assume that the growth is constant. But in most cases, especially for growth company, it's not. The growth company tend to go through high growth time period. It could be 5 years, 10 years, 15 years, so on and so forth. And then the growth rate will decline to a much lower number. And we can assume that the lower long-term growth is a constant number. So here, we can use so-called a two-stage model. In the first stage, that is a high growth time period, and the second stage is constant growth time period. And we can use the two-stage model, as you see here, to solve for stock price estimation. Let's take a look at one example. American Express. So why two-stage? American Express is large financial companies with competitive marketplace. Normally not a good candidate for above stable growth, but they've gone through an extended time period depressed earnings, and we expect the company will go through a strong recovery in the next 5 years, where the growth rate would be higher than normal. But in the longer term, we expect that growth rate will go down to a constant low number. And we don't use cash flow related model for financial companies, because for financial service company, free cash flows are really hard to estimate. So it's better to use dividend for our estimation. And also, this company has stable leverage and a stable beta. Therefore, this American Express is a really good candidate for two-stage dividend discounting model. Let's take a look at information about this company. EPS in 1995, $3.10, assuming we are in the beginning of 1996 and we are doing analysis on this company. And the dividend per share was 90 cents. That is D0. And let's assume that the length of the high growth time period would be 5 years, and the beta during a high growth time period would be a little higher than 1, that is 1.45. The cost of equity based on this beta and risk-free rate of 6%, ERP 5.5%, that will be around 14% cost of equity during high growth time period. And return on assets during a high growth time period, 14.56%, which is equal to return on assets in 1996 and 1995. We assume that this will continue into 1996. The dividend payout ratio is 29%. Debt to equity ratio 100%. Interest rate on debt is 8.5% with tax rate of 36%. And here, what we wanted to do is to estimate the expected growth rate. Expected growth rate equals the payout ratio. What is the payout ratio here? Payout ratio equals 1 minus dividend payout ratio, which is 70.97%. 1 minus 29.03%. That is a little over 70%. Times ROE, and this ROE equals ROA plus debt to equity ratio times ROA minus interest rate times 1 minus T. So that is converging from ROA to ROE. If you have ROE number, feel free to use ROE. But anyway, we are getting expected growth rate during the high growth time period, which is about which equal to 16.8%. This is a pretty tremendous number, right? But consider the expansion during the recovery time period. You would say, hey, 17% is not ridiculous estimation. Also, this based on the payout ratio and ROE, so it's pretty reasonable estimation. And for the second stage, we assume that the growth rate will be much lower, which is equal to 6%, and beta also will be lower during the stable growth time period, going from 1.45 to 1.1. Here, when you use two-stage model in your previous textbook, you might assume that beta would be equal or cost of equity would be equal, but actually you should use two different cost of equity. During the high growth time period, because company has high beta, and we should use a high return cost of equity. But for the second stage, when beta is going lower, then we should have lower cost of equity and lower cost of equity. So beta during stable growth time period will be lower. Let's assume that 1.1. If that is the case, then cost of equity during the stable growth time period would be 12%. Previously, the cost of equity during high growth time period is about 14%, but for constant growth time period, you see, it's 12%. ROA is expected to drop to 12.5%, and the stable payout ratio can be estimated at 69.33%. So here, you need to be very careful regarding this payout ratio, expected growth rate. Make sure that the growth rate estimation is consistent with company's payout policy as well as return on equity. And here's the table that you need to develop to do a typical two-stage model. And here we use EPS as source of cash. And during the first stage, we have 5 years. 5 years. Each every year, you will see high growth rate, and the growth rate is 16.9%. And we look at EPS and the payout ratio. Then you get estimated dividend per share. And then we discount each every dividends into its present value and add up all the present values of 5 year, next 5 year dividends. You will come up with $4.85 of value during this high growth time period. And for the terminal time period, we estimated that the cost of equity is around 12%, growth rate around 6%. And you look at expected earnings in year 6 as well as expected dividend, which is about $4.95. Then you apply golden growth model to calculate this terminal value, D6 divided by the difference between the constant growth time period required rate of return 12% and the growth rate during that constant growth time period, which will give you $81.87 of the terminal value of the company. But this terminal value is a future value. We need to discount it back to today, which is equal to $42.57. How do we do discounting? 81.87 divided by 1 plus required rate of return during the first 5 years, which is about 14%, and raised power 5. And the stock value, based on this two-stage model, would equal to $47.42, which is a combination of the value during the high growth time period, which is about $4.85, as well as the terminal value $42.47. And this illustration shows you how to calculate the value of the growth. And I think the growth rate is very important. Is a very important variable in your calculation, and actually is very sensitive to your stock price valuation. And this illustration showed you that the growth of the company do adds tremendous amount of value to the corporation. And you can look at the value of the assets in place, which equal to current EPS times payout ratio divided by cost of equity, which is about $7.47. That's the value of assets in place, assuming that those assets will not generate any future added value. And the value of the stable growth that we put in this calculation is 6%, right? And we can do another calculation to see what is the value of the company based on this 6% growth rate. So it's $3.10 times payout ratio times 1 plus G, then divided by the difference between cost of equity and the growth rate. And then you compare the difference between this 42 cents and $7.47. That's the value of the growth that American Express can contribute to the shareholders. And there are 3 major determinants of value of the growth. The first one, the length of high growth time period. The second is that growth rate. Of course, higher the growth rate, higher the value of the growth. And the third one is the cost of higher growth. As you see, when you assume that a company may have high growth rate, then you need to assume that the risk will be higher. Therefore, beta will be higher, required rate of return will be higher. It will cancel off the side effect of high growth on its value, because the required rate of return is the discount rate of your dividends. Okay, that concludes Chapter 13, Dividend Discounting Model. Pretty easy chapter. And I hope you enjoyed this video. I will see you next one. Free cash flow to the firm model. Thank you so very much.